Welcome to the deep dive. Today, we're really digging into a fascinating, maybe even confusing story in the consumer space. Deckers Outdoor Corporation. You know them, ticker DECKK.
Yeah, the parent company of UGG, of course, but also, and this is key, the powerhouse athletic brand HOKA.
Exactly. And the puzzle here is pretty stark. You've got this company, Deckers, whose stock has just been absolutely hammered. We're talking down over 50% from its high.
Right, hammered. But then you look under the hood and the business fundamentals. They look incredibly strong, consistently strong results, margins expanding, huge cash reserves.
And almost no debt, virtually zero long-term debt.
Precisely. So it's this real paradox we're looking at. How does a company with that kind of financial track record? I mean, think about it. A 29% earnings per share growth rate, compounded annually over 10 years.
Just stellar growth.
Stellar. How does that company end up trading at its lowest PE multiple since way back in 2016?
That's the core question we need to unpack for you today. Clearly, the market is reacting to something beyond just the historical numbers. It sees risk ahead.
Yeah, you've nailed it. It's this disconnect between, let's call it the intrinsic quality of the business, which seems high, and the market sentiment right now, which is, frankly, pretty fearful, driven by future concerns.
So our mission here is to dissect that. We'll look at the financial fortress Deckers has built, piece by piece. Then we'll dive into that recent Q2 earnings report for fiscal 26, the one that really seemed to spook investors.
And critically, we need to weigh those key risks everyone's talking about: tariffs, potential growth slowdown against the company's undeniable financial strengths.
We want to give you the full picture, help you understand what's driving this huge market correction and what it means when a high-quality company hits these kinds of headwinds.
Okay, let's get started. Maybe first just lay out the empire. What is Deckers today?
Right, so Deckers isn't just that UGG boot company anymore, not by a long shot. They've really transformed into this diversified footwear player. Still probably considered small to mid-cap, market cap, bouncing around, say, 11.8 to maybe $13.3 billion recently. And that transformation really shows up when you look at where the money is coming from, the revenue mix.
Yeah.
Though UGG is still incredibly important.
Oh,
Right?
absolutely vital. Looking at the fiscal year 2025 numbers, UGG is still the biggest piece of the pie. About 51% of total revenue, that's roughly $2.5 billion. It's the foundation.
But HOK.
Yeah.
HOK is the growth story.
HOK is the engine, yeah. It's pulling in about 45% of total revenue now, around $2.22 billion projected for FY25. And the other brands like Teva make up the small remainder, just about 4%.
And management's leaning into that focus, right? They're streamlining.
They are. They're actively pruning that other brands category. Most notably, they're phasing out the Koolaburra sub-brand's standalone operations by the end of 2025. It really signals they're doubling down on UGG and especially HOK.
Let's talk HOK first then, because that growth has been just, well, almost unbelievable. It's what really changed the narrative for Deckers.
It really has. I mean, think back to just 2021. HOK's revenue was $571 million. Fast forward to fiscal 25 projections, and it's $2.22 billion.
Wow. That's more than tripling in 4 years.
Pretty much. That sustained growth, consistently north of 30% annually, that's what's turned heads across the entire industry. And it wasn't just luck, it was strategic.
How so? What was the key move?
They brilliantly managed the brand perception. HOK started as a really niche running shoe, right? Known for that maximal cushioning aimed at ultramarathoners. Very technical.
It was really thick soles, yeah. Kind of distinctive.
Distinctive is one word for it. But they successfully took that distinctive look, that maximalist design, and turned it from a technical feature into a lifestyle statement, a fashion cue almost.
Which lets them command those premium prices. We're seeing $150, $200 a pair pretty commonly.
Exactly. And that's huge for margins. They aren't just pushing volume through discounts.
Yeah.
People are willing to pay up for the brand. It shows real pricing power.
And the product strategy seems pretty smart too. Not just chasing fads, but building on what works.
Right. They talk about developing product families rooted in their heritage. You see it in how they methodically update their big road running shoes, the Clifton, the Bondi, the Arahi. Keep the performance, refresh the style.
And they haven't forgotten their trail roots either. That Mafate franchise expansion seems key.
Very key. They've segmented it really well. You've got the Mafate X for like peak technical performance, then the Mafate 5 for more general all-terrain use, and they even brought back the Mafate Speed 2, aiming it squarely at that active lifestyle sort of fashion-forward crowd.
That detailed approach seems to be working in terms of market share, too.
It is. The data shows HOKA gained 2 points of share in the total U.S. road running market in the 12 months ending September 2025. That's significant gain in a competitive space.
And that anecdote about the UTMB finals.
Oh, yeah. The Ultra Trail du Mont Blanc World Series finals in Chamonix. Kind of the Super Bowl for ultra running. HOKA apparently had the highest shoe count among elite runners there.
So they've got the hardcore performance credibility and the mainstream lifestyle appeal. That's a potent combination.
A very potent combo. It's rare to nail both so effectively.
Okay, let's switch gears to UGG. People sometimes dismiss it as, just those winter boots, maybe a bit cyclical, but the numbers show real strength there too.
Absolutely. UGG has shown impressive resilience. People have predicted its demise multiple times, but it keeps proving them wrong. Revenue grew steadily from $1.7 billion back in 2021 to a projected $2.5 billion for fiscal 25. That's solid growth for what many consider a mature brand.
And culturally, it seems to be having a moment again, especially with younger consumers.
A big moment. There is a recent report indicating UGG is currently the #1 fashion trend among upper-income teenage girls. Think about that.
Number one, ahead of
Lululemon, actually. First time UGG has topped that list for that specific demographic since 2018. When you capture the attention and the disposable income of that group, you've got serious momentum.
And internally, Deckers is pushing UGG beyond just winter boots, right? This 365 focus.
Yeah, they're actively trying to reduce that seasonality, pushing products that work year-round. And it seems to be gaining traction. Men's footwear within UGG, for example, is apparently growing at twice the rate of the overall brand.
Are there specific products driving that non-winter success?
Definitely. The Numo franchise that's more of a chukka boot, sort of slip-on style, its sales apparently doubled year over year in the first half of the fiscal year. The classic micro boot is now a global top 5 style. And they launched a new style, the Zora Ballet Flat.
A ballet flat from UGG.
Yep. And it's reportedly outperforming expectations significantly right out of the gate. So they're successfully broadening the product mix under the UGG umbrella.
Okay, so zooming back out to the whole company for FY25. Geographically, it's still mostly U.S.-driven?
Still mostly U.S., yeah. About 64% of total revenue comes from the U.S. market, 36% international.
And the channel mix, wholesale versus direct-to-consumer, DTC. It varies by brand.
It does vary quite a bit. HOKA is still heavily weighted toward wholesale, about 63% wholesale, 37% DTC. They're still focused on expanding distribution reach.
Whereas UGG is more balanced.
Much more balanced. UGG is pretty close to parity, around 51% wholesale and 49% DTC.
And the big strategic goal for Deckers overall is to get that total company mix to 50-50, DTC wholesale. Why is that DTC piece so important for investors?
Margins. It's all about the margins. When they sell directly to you, the consumer, through their website or their own stores, they keep the entire profit. There's no retail partner taking a cut.
So higher profitability per sale.
Substantially higher. Driving that DTC percentage up is crucial for long-term operating margin expansion. And as we'll get into, the recent perceived difficulties in growing DTC as fast as wholesale became a real sticking point for the market.
Okay, let's pivot now from the brands and growth to the financial backbone of the company, because this is where that paradox we mentioned really hits home. The historical financial performance here is, well, it's exceptional.
It really is. When you look back over the last 10 years, these aren't the numbers of a company struggling. These are classic compounder metrics. Sales per share, for instance, have grown steadily, about 15% per year.
15% top-line growth per share consistently for a decade.
That's solid.
Solid. But the leverage they get on the bottom line is even more impressive.
Okay, let's hit those power metrics. Earnings per share.
EPS growth over that same 10-year period. An astonishing 29% per year compounded.
29%. And free cash flow, I remember that being even more eye-popping.
It is. Yeah. Free cash flow per share has grown at an incredible 41% annual rate over the last decade.
41%. Okay, that's the aha moment, isn't it? What does that massive FCF growth tell us?
It tells you they're not just selling more stuff. They're becoming dramatically more efficient at turning those sales into actual cash they can use. It signals huge improvements in operations, managing inventory, managing capital spending.
They're getting better at the underlying business mechanics.
Exactly. That ability to generate cash, accelerating faster than earnings, that's the bedrock of their financial strength, and it flows right onto the balance sheet.
Let's talk about that balance sheet. The debt situation is unusual for a company this size. Unusual in the best way possible. Deckers has essentially no long-term debt on its books. aside from standard operating lease liabilities, which every retailer has.
Zero debt. So their debt-to-equity ratio must be tiny.
It's minimal, around 14%. Think about that in today's environment, with rising interest rates. While competitors might be feeling the pinch from leverage, Deckers has complete financial freedom.
And liquidity. If things got tough short term.
They are swimming in liquidity. Their current ratio is about 3.0. For listeners, that means they have $3 in current assets, cash, inventory they can sell, money owed to them for every $1 of short-term bills they need to pay. That's phenomenal security.
And that's backed by a big pile of actual cash, right?
A huge pile. As of the end of September 2025, they reported $1.414 billion in cash and equivalents. Some earlier filings even showed that cash position closer to $2.24 billion. That's a massive war chest.
Give them options.
Tons of options. Fund growth, weather storms, make acquisitions if they wanted, or do what they've been doing, which is buying back stock. We'll come back to that.
Okay, so zero debt, tons of cash. What about profitability? Margins have been expanding too.
Dramatically. Let's start with gross margin. That's profit after the cost of the goods themselves. 10 years ago, it was around 45%. In fiscal 2025, it hit nearly 58%.
Wow, a 13-point jump in gross margin. What does that signal?
Pricing power. Pure and simple. It shows that consumers love the brands, particularly HOKA and UGG, enough to pay more over time. They haven't had to slash prices to drive that sales growth we talked about.
And that flows down to operating margin. Profit after all the operating costs.
It does. Operating margin expanded from just 10% a decade ago to hitting highs in the 23% to 24% range in the trailing 12 months. That's a massive improvement in overall profitability, showing great cost control as they've scaled up.
So even the guided lower margin for FY26 is still pretty strong.
Absolutely. Management guided to about 21.5% operating margin for fiscal 26, factoring in those tariff headwinds we'll discuss. Even that lower number is considered a top-tier level of profitability compared to most of their peers in footwear and apparel. They built a significant cushion.
To really hammer home the efficiency point, let's talk about how well they use the capital they invest.
Yep.
Return on invested capital, ROIC. How does Deckers stack up?
This might be the single most compelling metric. Deckers' trailing 12-month ROIC is over 35%. Just think about that. For every dollar they invest back into the business, building inventory, marketing, R&D, they're generating over 35 cents in profit. That is incredibly efficient.
How does that compare to, say, the big guys or their main competitors?
It blows them away, frankly. Nike's ROIC is closer to, around 21.9%. On holding, the fast-growing competitor HAA often gets compared to, their ROIC is around 16.3%.
So Deckers is generating almost double the return on capital compared to on holding.
Roughly double, yeah. That level of capital efficiency is a massive structural advantage over the long term.
And it's not just how they use capital, it's how quickly they turn over their inventory and get paid. The cash conversion cycle.
Another area where they excel. The cash conversion cycle measures how long it takes from spending cash on inventory to getting cash back from customers. Deckers averages about 58.5 days.
Which sounds fast. Is it fast compared to others?
Very fast. Nike takes significantly longer, around 95.3 days. And on holding, they're much slower, averaging about 181.1 days.
Wait, 181 days. So Deckers turns its inventory into cash more than 3 times faster than on holding.
That's what the numbers suggest. It points to superior inventory management, supply chain logistics, just operational excellence. That speed lets them reinvest cash back into the business much faster, fueling that amazing FCF growth we talked about earlier.
Okay, so Section 2 really solidifies the paradox. We've got stellar historical growth, industry-leading margins, incredible capital efficiency, zero debt, tons of cash. Fundamentally, this looks like an elite operation.
Absolutely, which makes the stock's nosedive even more jarring. And that leads us directly to Section 3. Why the sell-off? What happened?
Right, this is where the narrative completely flipped. Deckers reported their second quarter results for fiscal year 2026 back on October 23, 2025. And here's the weird part. The actual results for the quarter. They were great.
They were better than great, actually. They beat analyst estimates pretty handily across the board. Net sales were up 9.1% to $1.43 billion. Diluted earnings per share jumped 14% to $1.82, which crushed the consensus estimate of $1.58.
And the core brands performed well in the quarter, too.
Both delivered double-digit growth. HOK was up 11.1%, UGG up 10.1%. Solid performance from both engines.
So based on those results alone, you'd expect the stock to maybe pop, or at least hold steady. But instead,
It cratered, dropped over 10% right after the earnings call, and that added to the significant decline it had already experienced. The market basically ignored the strong Q2 results.
and focused entirely on the future.
The guidance.
Exactly. The full-year guidance for fiscal 2026 was cautious, very cautious, and that's what spooked investors. Management guided for total net sales of approximately $5.35 billion for the full year.
And that missed expectations.
It did. Analyst consensus was looking for something closer to $5.46 billion. It might not sound like a huge miss, but what it implied was a significant slowdown in growth. Right. Missing that target translates to an expected blended growth rate from UGG and HOKA of only around 9% for the year, which is a big step down from the 20-30% plus rates people had gotten used to.
Precisely. Deceleration is a dirty word for growth stocks. And then there was the margin guidance.
That came down too.
Yep. They forecast the full-year operating margin to be approximately 21.5%. That's a noticeable drop from that high 23%, almost 24% range they've been hitting recently. Investors hate seeing margin compression, even if the absolute level is still high.
And didn't the channel outlook also raise some eyebrows, something about wholesale versus DTC?
Yes. Management explicitly said they expect global wholesale growth to outpace DTC growth for the full fiscal year 26. That runs counter to their long-term strategic goal of boosting those higher-margin DTC sales.
Okay, so slower overall growth, lower margins, and maybe a less favorable channel mix in the short term. What drove that caution? Were there specific headwinds they called out?
There were. A big one was a slowdown in the domestic U.S. market. In Q2 itself, U.S. net sales actually decreased by 1.7%.
Decreased. Wow.
Why? Management pointed to pressure on U.S. consumer sentiment. They mentioned seeing maybe a bit more price sensitivity, consumers reacting to price increases, and maybe a shift towards shopping in multi-brand stores rather than directly from Decker's own channels.
Which would explain the pressure on DTC.
Exactly. That high-margin direct-to-consumer channel felt the pinch. Overall, DTC net sales were down 0.8% in the quarter, and comparable DTC sales stripping out new store openings closures were down 2.9%.
Okay, wait, so DTC is down, but overall sales are up because wholesale was strong.
That's the story. Wholesale net sales jumped 13.4% in the quarter. Management's explanation is basically that demand from their retail partners, the department stores, the specialty shoe stores, is so strong that they're asking for and getting product earlier and in larger quantities.
So sales that might have happened on Decker's website later are happening in a partner store earlier.
That's the argument. They frame it as a sign of brand strength and strong demand, leading to earlier shipments into the wholesale channel. This boosts wholesale numbers now, but naturally pulls down the DTC numbers in the short term.
Okay, so maybe a timing issue driven by success, but it still hits those high-margin DTC numbers temporarily? Understandable why the market might worry about that.
It introduces short-term margin uncertainty, definitely. But the real elephant in the room, the issue that pretty much guarantees margin pressure, was tariffs. The big $150 million question.
Right. Tariffs. Explain the impact there.
Management put a number on it. They said the unmitigated impact of tariffs, if they did absolutely nothing, would hit them for about $150 million in fiscal year 2026.
$150 million. That's a huge number relative to their profits.
It's massive. And the fear around this tariff impact was actually what caused the stock's initial big plunge earlier when guidance was first pulled due to the uncertainty. Putting this concrete large number on it just solidified the market's fear.
But they are doing things to mitigate it, right? They're not just taking the full hit.
Correct. They have mitigation strategies in place. They expect those efforts, things like strategic price increases and cost sharing with suppliers, to offset somewhere between $75 million and $95 million of that $150 million impact.
Okay, so cutting the impact roughly in half, what does that leave as the net hit?
It means the net ongoing financial drag from tariffs in FY26 is expected to be somewhere in the range of $55 million to $75 million. Still a significant chunk of change, still a headwind, but maybe more manageable than the full $150 million.
Where are they finding those offsets, price increases?
That's a big part of it. They're implementing selected strategic price increases. And remember that brand strength and pricing power we talked about? So far, they say they haven't seen significant consumer pushback on those hikes. The brand elasticity seems to be absorbing it.
And cost sharing, getting suppliers to help.
Yeah, they mentioned leaning on their long-term factory partnerships to share some of the burden of the increased costs.
This whole issue really highlights the reliance on overseas manufacturing, though. Where are they making most of their stuff now?
Heavily reliant on overseas, yes. Vietnam is a major hub. They have 14 Tier 1 factories there. They've successfully reduced their reliance on China significantly less than 5% of footwear sourced from China now, but the geopolitical risk from tariffs impacting goods from regions like Southeast Asia remains high.
And this tariff pressure isn't just a one-off for this year.
No, and that's critical. The CFO stated on the earnings call that this gross margin pressure, driven mainly by tariffs, is expected to impact not just the second half of fiscal 26, but also likely continue into the first half of fiscal 27, assuming the current tariff situation doesn't change.
Okay, so the market isn't just reacting to a slightly slower quarter or a guidance miss. It's reacting to a clear, quantifiable, and potentially ongoing financial headwind that directly impacts margins and slows that incredible growth trajectory they've been on.
That's exactly it. It's pricing in that future pain.
Which brings us right to valuation. If the underlying business quality we detailed earlier is still largely intact, does this massive sell-off create an opportunity? Is the market overreacting?
That's the core debate right now among investors. And when you look at the valuation metrics, you can see why people are asking that question. The stock's price-to-earnings ratio, the PE, has fallen dramatically.
Where's it trading now?
Depending on whether you use trailing or forward earnings, it's hovering around a PE of 13. Some reports even put the forward PE closer to 11.8 or 12.
13 times earnings. For a company with Deckers' track record and brands, how does that compare historically?
It is exceptionally low for Deckers. It's the lowest PE multiple the stock has seen since way back in 2016.
Wow, so the value argument is pretty straightforward then.
It is. The thesis being pushed by many value-oriented investors is exactly that. The market is being overly pessimistic. It's taking these short-term fears, the tariffs, the modest growth slowdown, and extrapolating them too far, ignoring the fundamental strengths. They see it as a classic overcorrection for a high-quality compounder.
And it seems like the people running the company agree with that assessment, judging by their actions.
Absolutely. Management's response to the falling stock price has been unequivocal. They've gotten incredibly aggressive with share repurchases, buying back their own stock.
Deckers doesn't pay a dividend, right?
Yeah.
So buybacks are their main way of returning capital to shareholders.
Correct. And their commitment to buybacks during this downturn has been striking. Back in June 2025, the board authorized a massive increase to the buyback program, an additional $2.25 billion.
$2.25 billion.
Yeah.
On top of what they already had.
Right. It brought the total authorized amount for share repurchases to approximately $2.5 billion. Now consider this. At the time they announced that increase, $2.5 billion represented about 12% of the company's entire market capitalization.
12%.
Yeah.
So they basically announced plans to buy back 12% of their own company. That's a huge statement of confidence.
A massive vote of confidence from management and the board. And they're not just talking about it, they're doing it. In that tough Q2 fiscal 26 quarter we just discussed, they actually repurchased 2.6 million shares.
How much did they spend?
Yeah.
And at what price?
They spent $282 million in that quarter alone. And the weighted average price they paid for those shares was $109.31.
Okay, so management is putting serious company money to work, buying shares around $109, signaling they think it's undervalued there.
Unequivocally, when management bets billions of the company's own cash buying stock at these depressed levels, it sends a very strong signal that they believe the current market price is a temporary discount compared to the long-term intrinsic value they see.
And this isn't new for them, right? They've been reducing the share count for a while.
They have. Thanks to this consistent buyback activity over the last 4 years or so, they've already reduced the total number of outstanding shares by about 10%.
Which means each remaining share owns a slightly bigger piece of the pie, boosting future EPS even if net income growth slows a bit.
Exactly. It's a powerful tool for enhancing shareholder value over the long run, especially when shares are bought back at what management perceives to be attractive prices.
So how are Wall Street analysts viewing this? What's the consensus rating?
The consensus among analysts covering the stock is currently a moderate buy. The average price target is hovering around $118 per share, which suggests they see pretty decent upside from where the stock has been trading recently.
Though those targets probably came down a bit after the guidance.
They did. You saw some analysts trim their targets maybe from the 120s or 130s down to the $110, reflecting that more cautious near-term outlook, but still generally positive.
And are we seeing big institutional investors, the so-called smart money, buying into this dip?
There's evidence of that, yes. Reports indicate several large institutions have been increasing their positions during this period of stock price weakness. For example, Trillium Asset Management reportedly upped its stake by over 28%. Another large fund, Trej AP Fonden, apparently increased its position by a massive 507%.
Wow, a five-fold increase. So some big players are definitely seeing this as a buying opportunity.
It certainly looks that way. They're likely attracted by that low valuation, the strong underlying business quality, and that aggressive buyback program signaling management conviction.
Okay, but we can't just focus on the potential bargain. We have to be clear about the ongoing risks too, beyond just the tariffs. If Deckers is going to regain its former valuation multiple, what hurdles does it still need to clear?
Good point. Risk number one is definitely brand concentration. As strong as UGG and HOKA are, they now make up something like 90% of the company's total sales.
So almost all their eggs are in those two baskets.
Pretty much. While that focus drives efficiency right now, it also creates enormous vulnerability. If either of those brands were to stumble significantly, say, HOK loses momentum in running, or UGG falls out of fashion with those teens.
The whole company's performance and the stock price would take a massive hit, regardless of the balance sheet.
Absolutely. Which leads directly to risk number two, the inherent cyclicality and trend risk in the footwear and apparel industry.
Fashion is fickle.
Extremely fickle. UGG has navigated these cycles before, showing impressive staying power, but its current peak popularity isn't guaranteed forever. Management has to keep innovating, keep executing on that 365 focus to maintain relevance year after year.
And the third major risk, competition.
Competition is intense, especially for HOK. It's battling not only the established giants like Nike and Adidas who have massive resources.
Huge marketing budgets, global distribution.
Right. But maybe even more directly, HOK is fighting against other fast-growing, technically focused brands vying for that same performance and lifestyle consumer. On Holding, ticker ON, is the obvious example there. They're also growing rapidly and have built strong brand heat.
So Deckers needs to keep leveraging that operational excellence, that superior ROIC and cash conversion we talked about, to maintain its edge against these well-funded and ambitious competitors.
Precisely. Their efficiency is a key part of their competitive moat. #tag outro. Okay, so let's try to bring this all together. What's the key takeaway from our deep dive into Deckers?
Well, it seems pretty clear we're looking at a company with exceptional underlying financial health, extremely profitable, virtually no debt, fantastic capital efficiency metrics, and two powerhouse brands in UGG and HOK that are still growing and taking share globally.
Right. HOK's global expansion and performance cred, UGG's surprising resilience and teen appeal. The core business looks strong.
But the stock price action tells a completely different story recently. And that volatility seems almost entirely driven by future concerns, not present performance.
Exactly. It's fear about what's coming, specifically the very real, quantifiable impact of tariffs hitting margins, the cautious guidance suggesting growth is slowing down from its previously torrid pace, and just general worries about the economy impacting consumer spending, particularly in the U.S.
So for you, the listener trying to make sense of this, the Deckers situation is almost a perfect case study. It highlights that critical distinction between fundamental business quality, the stuff like zero debt, high ROIC, strong brands, and market sentiment, which can be swayed dramatically by near-term fears, geopolitical risks like tariffs, and changing growth expectations.
Yeah, the central question for anyone looking at Deckers now is, are the company's strengths, that brand power, that operational efficiency, that fortress balance sheet strong enough to absorb this margin hit from tariffs and navigate a period of slower growth without fundamentally damaging the long-term value proposition?
And management's answer seems clear given their actions. They're betting heavily on the core business, choosing to pour billions into buying back their own stock at these lower prices rather than, say, making a big acquisition.
That confidence, demonstrated through the buybacks, really frames the final provocative thought we want to leave you with. In an industry this competitive, this trend-driven, is relying on internal operational excellence and that pristine balance sheet enough of a long-term moat.
Or should management perhaps be using some of that huge cash pile, that financial flexibility, to prioritize long-term stability through diversification? Maybe making a strategic acquisition to add a third growth pillar instead of concentrating so much capital on just repurchasing shares.
It's that classic capital allocation dilemma, isn't it? Maximize immediate shareholder value through buybacks while the stock is perceived as cheap. Or invest for potentially greater long-term resilience and diversification, even if it means less immediate EPS accretion. That's the strategic tightrope Deckers is walking right now.
A fascinating situation to watch unfold. Thank you for joining us on this deep dive. We'll catch you next time.